Welcome to another episode of RegTalks. In the next few minutes, we'll walk through one of the key tax developments from the past week reported by RegFollower. UAE transfer pricing adjustments. What has actually changed? The UAE Federal Tax Authority has issued an important clarification on downward transfer pricing adjustments. The practical message is simple. If a UAE company has reported more profit than it should have earned under the arm's length principle, it may reduce that profit directly in its corporate tax return. It does not need to obtain advance approval from the FTA, but this is not a new tax planning opportunity. And it is certainly not permission to move profit out of the UAE whenever the group finds it convenient. The adjustment must reflect the economic reality of the transaction. It must be documented, disclosed in the tax return, and in principle matched by a corresponding adjustment at the level of the other group company. So when can a legitimate downward adjustment actually arise? After all, related party contracts should have been priced on an arm's length basis from the beginning. The answer is that arm's length pricing is often based on forecasts, provisional data, and assumptions that later turn out to be different from reality. Consider a limited risk distributor. At the beginning of the year, the group may set its purchase prices using forecast revenue, forecast operating costs, and a target operating margin of, for example, 3%. By the end of the year, actual sales may be much higher than expected. The distributor may therefore report a 10% margin, even though its functions and risks have not changed. A year-end true-up may then be required to bring the distributor back to the arm's length result. The same issue arises with service companies. A UAE company may be remunerated on a cost-plus basis. However, the monthly charges may have been calculated using a provisional cost base. At year-end, the group discovers that certain costs were omitted, allocated incorrectly, or included in the wrong entity. The final service fee may therefore need to be adjusted. This is not necessarily evidence that the original contract was wrong. The contract may have contained an arm's length pricing mechanism, but the final amount could only be calculated once the actual annual figures became available. Another common example is an IT or software group. A UAE company may contract with customers and initially retain a significant part of the revenue, but during the year, the group may centralize product development, intellectual property management, and key commercial decisions in another jurisdiction. If the UAE company no longer controls the important risks and performs only routine sales or support functions, its final remuneration may need to be reduced. Of course, such an adjustment cannot be based simply on the statement that the intellectual property is owned elsewhere. The group must show where the development is managed, who controls the budget, who makes product decisions, who has the authority to stop or redirect a project, and who actually bears the commercial consequences if the product fails. Trading companies may face a similar situation. A UAE entity may initially be treated as the group's principal trader, but the factual analysis may show that supplier selection, pricing decisions, credit risk management, and inventory decisions are actually performed by the parent company. In that case, the UAE entity may be entitled only to a routine distribution margin or commission rather than the entire trading profit. The clarification is particularly relevant for year-end adjustments, but it should not be used to repair structures that have no commercial logic. A company cannot simply decide after the year end that its UAE profit is too high and move part of it to the parent company. There must be a real transfer pricing reason. Usually, that reason will be one of the following. Actual results differed from the forecasts used to set provisional prices. The functions or risks changed during the year. The cost base was calculated incorrectly. A contractual pricing formula requires a year-end reconciliation, or new benchmarking shows that the provisional result falls outside the arm's length range. The FTA also expects proper evidence. The company should be able to explain why the original amount differed from the final arm's length result. It should have a functional analysis, an economic analysis, the calculation of the adjustment, and a reconciliation between the financial statements and the corporate tax return. Importantly, every downward adjustment must be disclosed, even if the amount is relatively small and the normal related party disclosure thresholds are not exceeded. The other side of the transaction also matters. If the UAE company reduces its profit by 7 million dirhams, the group should normally be able to show that the corresponding 7 million has been recognised by the related party. Otherwise, the adjustment may create income that is taxed nowhere. This is also where foreign law becomes critical. The FTA may accept the downward adjustment in the UAE, but that does not automatically mean that the parent company's jurisdiction will recognise the corresponding income, additional expense, credit note, or amended invoice. The group must therefore check both jurisdictions before making the adjustment. It may also need to consider withholding tax, VAT, customs valuation, and the timing of income recognition. Finally, this clarification does not apply where the adjustment originates from a foreign tax authority. Suppose the Dutch, German, or Kazakh tax authority audits the parent company and increases its taxable profit because it believes that too much income was allocated to the UAE. The UAE company should not simply make a downward adjustment in its own tax return under this clarification. That is a different process. The company may need to request a corresponding adjustment from the FTA and, depending on the applicable tax treaty, initiate a mutual agreement procedure. So the practical conclusion is this. A UAE company may now make a downward transfer pricing adjustment without asking the FTA for advance approval. But the adjustment must be part of a genuine arm's length true-up, not an after-the-fact profit allocation exercise. Before making it, the group should answer 4 questions. Why was the original price different from the final arm's length result? What facts or figures changed? Where will the corresponding income be recognised? And can the group prove all of this during an audit? If those questions have clear answers, the clarification provides a useful and workable mechanism. If they do not, the adjustment is likely to create more risk than it solves. Thanks for watching RegTalks. See you next time.